Imagine the entire economy of Canada. Every business, every factory, every home, every single dollar of its national worth, vanishing into thin air. Not over a slow, painful recession, but in the span of a single afternoon. That's the sheer, incomprehensible scale of what happened on October 24, 1929. In just 6 frantic hours, $14 billion, a sum larger than the entire Canadian economy was worth, evaporated from the American financial system. 13 million shares of stock were dumped in a tidal wave of pure, unadulterated panic. The telephone lines to the New York Stock Exchange, the nation's financial heart, became so clogged with desperate orders they simply burned out, severing the country from its own economic pulse. We all know the name for this catastrophe, the Great Depression. But what we've largely forgotten is that this wasn't a random act of God or an inevitable economic cycle. This was a man-made disaster, a catastrophe with a trigger man. His name was Charles Edwin Mitchell, and the press had christened him Sunshine Charlie, America's most popular and trusted banker. Just 7 months before the world came crashing down, he made a single, monumental decision. A move he genuinely believed would save the American economy, that instead lit the fuse on the most devastating economic collapse in modern history. This is the story we think we know, but we've only ever heard the cliff notes. This is the untold story of the man who, with the best of intentions and the worst of consequences, quite literally crashed the world. Because the real full story of 1929 is so much more than a stock market crash. It's a chilling blueprint for how financial innovation, when divorced from responsibility and regulation, can become a weapon of mass destruction. It's a story about a revolutionary idea that every American, from the factory worker to the farmer, should have a stake in Wall Street, that was twisted into a predatory system that leveraged the dreams of millions against them. By the time the dust settled, a grueling decade later, the statistics read like a horror story. 25 million people, 1 in every 4 Americans, were thrown out of work. 5,000 banks had collapsed, their vaults permanently locked, taking with them the life savings of countless families. 2 million people were homeless, forced to build shantytowns of cardboard, tar paper, and despair on the outskirts of cities, bitterly naming these slums Hoovervilles after the president they blamed. The suicide rate spiked by 30%. In New York, the Brooklyn Bridge became such a notorious site for desperate leaps that police patrols were increased. In the nation that had just recently crowned itself the richest on earth, the most potent symbol of the era was the breadline, where formerly proud men stood for hours waiting for a free meal. And tracing this entire arc of devastation back to its origin leads us, inevitably, to one man's brilliant, flawed, and ultimately catastrophic vision. To truly grasp how Charles Mitchell pulled this off, you have to immerse yourself in the dizzying optimism of the world he inhabited. The 1920s in America weren't just prosperous, they were a revolution in lifestyle and expectation. This was the era of the Ford Model T, putting the open road within reach of the middle class. It was the age of radio, connecting the country with a shared culture of news, sports, and jazz. Skyscrapers, like the Chrysler Building, were piercing the sky, literal monuments to boundless ambition. It felt like a new modern world was being built, and it seemed that the prosperity fueling it would last forever. And in this world, the stock market was a gated community for the elite. Less than 1% of the population, a mere 500,000 people, owned stocks. For your average Joe, the mechanic, the secretary, the school teacher, finance meant a passbook savings account at a local bank, or if you were a little more sophisticated, some conservative bonds. The dizzying gains of Wall Street were a spectator sport. You could watch from the sidelines, but you couldn't get in the game. Charlie Mitchell looked at this exclusive club and didn't see tradition. He saw a massive, untapped, and inefficient market. When he took the helm of National City Bank, a behemoth with assets of $2.7 billion, more than the national budget of most countries at the time, he arrived with an almost evangelical vision. He proclaimed every American should be a capitalist. In his view, why should the incredible wealth being generated by American industry flow only to a small class of inherited money and financiers? Why shouldn't the common man get a piece of the action? So, in 1920, he launched his revolutionary vehicle, the National City Company. Its mission was deceptively simple and, for its time, radical: sell stocks and bonds to ordinary Americans. Right over the counter at their local National City Bank branch, Mitchell understood that he wasn't just selling financial products, he was selling a new future. He was a savant of sales psychology, and he turned his army of bankers into what he called dream merchants, trained in a sophisticated system of persuasion he designed himself. They were no longer just door clerks counting money. They were financial advisors, guides to a brighter, wealthier tomorrow. The advertising campaign was a masterpiece of modern marketing. Newspapers across the country were filled with ads that screamed, "Get rich by investing just $15 a month and become a partner of American Telephone and Telegraph." Magazines published glowing testimonials, the 1920s version of influencer marketing. How a secretary from Ohio retired at 40, or a streetcar driver buys his own home with stock dividends. The salespeople were taught to use clever psychological pitches. They'd say to a customer, "Mr. Johnson, you don't want to work for someone else your whole life, do you? General Electric stocks are your ticket to being your own boss." Or, to a wife, "Mrs. Smith, your husband works for Ford. Why don't you become a owner of the company?" The bank offices themselves were stage sets for this drama of aspiration, decorated with posters showing beaming families in front of large homes and new cars, with captions like, "Thanks to wise investing, we bought our dream home." But the true, terrifying genius of Mitchell's system, the engine that allowed this dream to go viral, was the widespread and reckless use of buying on margin. The concept was, and still is, seductively simple. Let's say you wanted to buy $1,000 worth of Radio Corporation of America stock. In a sane world, you'd need $1,000. In Mitchell's world, you only needed $100. You'd put down that 10%, and the bank would loan you the other $900. The math was intoxicating. If the stock price rose just 20% to $1,200, you could sell it, pay back the bank's $900, and walk away with $300. You'd just tripled your money. A salesman would illustrate it with easy, compelling arithmetic. "Look, Mr. Brown bought $500 of stock, but only put down $50. In 6 months, it went up $150. That's a 300% return on his money. Your savings account would have given him a measly $15. The result was a speculative explosion that dwarfed anything in history. Between 1925 and 1929, the volume of these margin loans skyrocketed from $2 billion to a staggering $8.5 billion, a 425% increase in just 4 years. The number of Americans in the stock market ballooned from 500,000 to 10 million. People were hawking their furniture, mortgaging their homes, and liquidating their life savings to get in on the action. A teacher from Ohio remortgaged her family home to buy Radio Corporation stock. A farmer from Kansas sold his entire herd of cattle to get into General Motors. A mechanic in Detroit invested 6 months of his salary into Ford. Everyone was playing the game. And Sunshine Charlie Mitchell was its undisputed master of ceremonies, a financial prophet earning a staggering $1.2 million a year, the equivalent of over $20 million today. Mitchell, however, was just getting started. He pushed the envelope further by creating complex investment trusts. These were essentially the first mutual funds, but with a dangerous twist. A trust would pool money from thousands of small investors to buy a portfolio of stocks. But the trust itself would often borrow even more money to buy more stocks, leveraging its bets. Then, the trust would sell shares of itself to the public, and those shares could, you guessed it, be bought on margin. It was a pyramid of debt built upon a foundation of hope, a hall of mirrors where the same dollar was being used and reused to fuel an ever-growing speculative mania. The entire financial system was becoming dangerously interconnected and dangerously fragile. By the spring of 1929, the smart money, the seasoned investors, the large institutions, started to feel a chill. The Federal Reserve, America's central bank, saw the glaring red flags. Stock prices had completely lost touch with economic reality. Companies were trading at price-to-earnings ratios of 15 or 20 to 1, levels that screamed speculative bubble. The market wasn't being driven by company performance, but by the sheer self-perpetuating momentum of margin-fueled buying. On February 6, 1929, the Fed issued a formal warning to banks across the country: stop the reckless lending for stock speculation. The market, addicted to easy money, immediately got the shakes. In early March, prices began a sharp decline. Billions in paper wealth vanished in a matter of days. The panic was palpable. It seemed the bubble was finally about to pop. And this is the precise moment Charles Mitchell stepped onto the stage and made the decision that sealed the fate of the decade. On March 12, 1929, in a direct and brazen act of defiance against the Federal Reserve, he called a press conference and declared that his national city bank would provide the market with all the liquidity it needs. He arrogantly promised, "We will not allow an unnecessary crisis to occur." The headlines the next day were pure jubilation. Sunshine Charlie saves the market. The effect was instantaneous. The market didn't just recover, it went ballistic, rocketing upward into its final most insane and irrational phase. The Dow Jones Industrial Average soared to a historic high of 381 points, a peak that wouldn't be surpassed for 25 years. Mitchell's intervention was a psychological atom bomb. He had sent an unequivocal message to every speculator in America. Don't worry, the big banks have your back. There is no downside. It was the creation of moral hazard on a national scale. 3 million new investors rushed into the market in those last few months. The stories became legendary. Wives secretly pawning their jewelry, shoeshiners offering hot stock tips to their wealthy clients, and children using their allowance to buy a share or two. The country was intoxicated by the illusion of easy, perpetual wealth. People who had bought in early saw their paper statements swell and felt like financial geniuses. Clerks became millionaires, at least on paper. But behind this glittering facade, the mathematics of catastrophe were ticking like a time bomb. The entire market was now a house of cards where 90 cents of every invested dollar was borrowed. This meant a mere 10% price drop would wipe out the entire equity of a margin investor. A 50% drop, which was once unthinkable, would not only obliterate their life savings, but leave them deeply in debt to their broker. By the autumn of 1929, the insiders knew the jig was up. Economic indicators were quietly turning sour. Industrial production was slowing, car sales were slumping, and construction of new homes was declining. All signs the real economy was cooling off, even as the stock market party raged on. Large, sophisticated players like Joseph P. Kennedy, the father of the future president, began quietly, methodically selling their holdings. Kennedy later famously quipped that he knew it was time to get out when he received stock tips from his shoeshine. It was a clear sign that the market had been taken over by the uninformed and the overly leveraged. The stage was set for the final act. On the morning of October 24th, Black Thursday, the coordinated sell-off began. Major investment trusts and institutional investors, having quietly exited their positions, started dumping massive blocks of stock onto the market. The selling pressure was immense. Prices began to slide, then tumble, then freefall. The dominoes that Charles Mitchell had so carefully arranged began to topple in a terrifying, predictable sequence. First domino, the falling prices triggered automatic margin calls. Brokers, required by law to maintain the collateral on their loans, sent out tens of thousands of telegrams and phone calls demanding investors put up more cash immediately. Second domino, the vast majority of these small-time investors had no more cash. They had put every cent they had, and much they didn't, into the market. Their only option was to sell their shares to cover the loan. This forced selling drove prices down even further. Third domino, as stock prices cratered, they were no longer considered valuable collateral. Banks and brokers, seeing their security vanish, slammed the brakes on issuing any new margin loans. The flow of easy money, the very lifeblood of the boom, stopped dead. Fourth domino, the banks that had been most aggressive in lending, the ones that had followed Mitchell's playbook, now found themselves holding millions of dollars in worthless loans. They began to fail, sparking runs on other banks. On Black Tuesday, October 29th, the final collapse came. A record-shattering 16.4 million shares were traded. The ticker tape ran hours behind, meaning people were selling blindly, not even knowing the current price of their holdings. The total losses for the day were a mind-numbing $14 billion. The human cost was immeasurable. Edward Hopkins, the Detroit mechanic, saw his $5,000 life savings in Ford stock become worthless. When the bank demanded an additional $3,000 he didn't have, he hanged himself in his garage. Mary Cayfield, the Ohio teacher, watched the bank foreclose on the family home she had mortgaged, leaving 3 generations of her family homeless. And what became of the architect of this ruin? In 1933, he was summoned before the Senate Banking Committee, a humiliated man facing a nation demanding answers. Senator Carter Glass, the fiery co-author of the act that would soon bear his name, pointed a finger and asked the question on the lips of millions: do you consider yourself responsible for the ruin of millions of American families? Mitchell's response was a masterpiece of unrepentant deflection. I wanted to give people the opportunity to get rich. No one forced them to buy stocks. It was the ultimate buyer beware defense. While he avoided criminal liability for the crash, justice found him for his other dealings. Later that year, he was tried for tax evasion, having failed to pay taxes on a personal profit of $850,000. He was acquitted in a controversial verdict, but his reputation was shattered. He was forced to resign from National City Bank in complete disgrace. The man once hailed as a savior was now the national poster child for Wall Street greed and irresponsibility. He was booed on the streets of New York. A Detroit newspaper captured the public mood perfectly, writing, "Charles Mitchell stole more from us than any bank robber in history." A robber takes a bag of money, but Mitchell took the future from an entire generation. The aftermath of the crash and the depression it triggered forced a fundamental restructuring of the American financial system. The public and political outrage was so immense that Congress was compelled to act. In 1933, they passed the Glass-Steagall Act, which erected a solid wall between commercial banking, taking deposits, and making loans, and investment banking, underwriting securities, and speculating. The goal was simple and stark. Never again should a banker be able to gamble with the life savings of depositors. The same year, the Securities Act of 1933 was passed, requiring companies to provide truthful information to investors. In 1934, the Securities and Exchange Commission (SEC) was created to police the markets, and the Federal Deposit Insurance Corporation (FDIC) was established to protect the savings of ordinary people. Strict limits were placed on margin trading. America was determined to make sure this would never, ever happen again. But the government's response also included a more radical and often forgotten chapter born of sheer desperation. In April 1933, President Franklin D. Roosevelt, just weeks into his presidency, signed Executive Order 6102. In a move that would be unthinkable today, it became a criminal offense for private citizens to own most forms of gold. Americans were ordered to surrender their gold coins, bars, and certificates to the government in exchange for the fixed price of $20.67 per ounce. This was a desperate last-ditch effort to break the deflationary spiral. As long as people could demand gold for their dollars, the government's ability to print money and stimulate the economy was severely limited. The gold confiscation allowed the Fed to dramatically increase the money supply. It was a massive violation of property rights justified by a national emergency. Within a month, Americans surrendered over 3,600 tons of gold. Then, in a move that added insult to injury, the government promptly raised the official price of gold to $35 an ounce, effectively giving itself a multi-billion-dollar profit on the metal it had just confiscated from its own citizens. It was a stark lesson in the extreme measures a government will take when faced with total economic collapse. So why does this story, now nearly a century old, matter to you, staring at a screen in the 21st century? Because we are living in the era of sunshine, Charlie's digital reincarnation. The parallels are not just striking, they are terrifying. Today, over 50 million Americans trade stocks not through a bank teller, but through sleek apps on their smartphones. The volume of margin debt has repeatedly hit record highs, hovering near the $900 billion mark. Platforms like Robinhood, with their game-like interface, zero commissions, and addictive push notifications have done exactly what Mitchell set out to do. They have democratized speculation. Their very marketing echoes his 1920s slogans, "Investing for everyone, own your future." We see the same dynamics in the wild, social media-driven volatility of meme stocks, where communities of amateur investors can band together to inflate and deflate prices based on sentiment, not value. We see it in the casino-like frenzy around cryptocurrencies and NFTs, entirely new asset classes built on FOMO and the promise of generational wealth. The language is new, staking APY to the moon, but the underlying psychology is identical. The seductive belief that easy money is available to anyone with a few dollars and a dream. The average American household debt is now higher than it was before the 2008 financial crisis. And the relentless drumbeat of financial influencer culture encourages ever more risk-taking. We are once again building a towering edifice of perceived wealth on a fragile foundation of credit and confidence. And we are being told, just as they were in 1929, that this time is different. The tools have changed, but the game remains the same. The story of Charles Mitchell is the ultimate cautionary tale in the seductive and often dangerous relationship between innovation, greed, and regulation. It's a story about how a seemingly noble idea, democratizing wealth and giving the little guy a chance, can be perverted into a system that systematically exploits optimism and leverages it into catastrophe when it is built on a foundation of excessive debt and a willful disregard for risk. Mitchell wanted to make every American a capitalist, but he forgot that sustainable capitalism requires not just opportunity, but also prudence, transparency, and a sober acceptance of consequence. The next time you see an ad promising effortless returns, or an app nudging you to level up your portfolio with margin, remember Sunshine Charlie. Remember the teacher who lost her house, the mechanic in his garage, and the millions who stood in breath lines. Ask yourself who is really selling the dream, and who will be left holding the bag when the music, which always does, finally stops. History may not repeat itself, but as Mark Twain is often credited with saying, it often rhymes. If this deep dive into the roots of financial disaster has made you see our current moment in a new light, do us a favor and hit that like button and subscribe. We're just getting started, and there are so many more stories like this to uncover. In the comments, we want to know, do you see the parallels today? Are we building a new digital house of cards? Let's get a conversation going. Thanks for watching.